welcome to the Legacy Lounge, Nick.
Oh, Deb, you're so nice to have me. I really appreciate it.
We're so excited. For those who don't know your background, you're president and co-founder of Strategas. And we're going back to 2006, a great run with a phenomenal company.
Yeah.
And so we are happy that you are christening the Legacy Lounge, the first podcast of the year. And I'm sure people are excited to hear what you have to say. Again, welcome, and tell us a little bit about Strategas and your background so we can learn about the firm.
Yeah, well, Deb, I'm super excited to be here with you. You and I have had a good run as well over the years, and so this is a real treat for me to be here in the Legacy Lounge. I'm excited about it. Strategas was, as you say, started in 2006. My partner, Jason Trenner, Don Rissmiller, and I were at another macroeconomic firm. And, truth be told, we really just had an itch to sort of strike out as entrepreneurs. We loved the industry, loved where we were, but we wanted to see if we couldn't do it, for ourselves. And so the real core tenets of the firm were to focus on the macroeconomy, try to make it accessible and digestible for investors, whether they be super professional in the weeds, institutional managers or financial advisors, folks who are, dealing with individuals and families and life planning considerations. And so, over 15, 16, 17 years, we've sort of developed this practice that is, very focused on all the moving parts of the economy, trying to make heads and tails of it, ultimately sort of delivering it hopefully in a pretty easy to consume format. We've got about 55 people on the team now. About half of those are in the research effort or the asset management effort, sort of focused on doing the research and then putting it into practice. And as you say, we're headquartered largely in New York, but we have a small office in Washington, D.C., which of course has been a little bit of the center of the universe the last couple of years. And I don't mean that overtly politically, but it's just, from the pandemic through COVID, and now today, obviously, politics and policy has become super, super important. So we think of the world from a policy standpoint. We think of it from an economic standpoint, Deb, as you know. We think of it from a fixed income and equity markets standpoint. And then ultimately, how does that all make sense for the investor?
And the viewpoint from DC has been important. Dan Clifton's been living his best life
yes.
over time
Yeah.
As your partner. And you do take the macroeconomic view really up front and center.
Yep.
And a lot of people may not understand the importance or the relationship to portfolio management on that. I should mention that, Strategas for the 8th straight year in a row
You're nice.
has been claimed the number one position in macroeconomic research as gauged by Institutional Investor.
Yeah.
And I just think it's so important. Can you talk about, the evolution? Because you started in the research and there's been a transformation to more even full service.
Yeah.
So tell us about that.
Yeah, one of the things I find fascinating about just the industry in general is how it's been doing the same thing for a long time, but it's evolved in how it's been doing the same thing for a long time. And so if you look back into the 60s and the early 70s, you had the advent of the mutual fund that most people, the traditional mutual fund that people are familiar with. You had the advent of individual stock research. There was the discovery of small and mid-cap stocks. Those had never really been investable securities for the average investor. And then as you came forward into the 90s, you ended up with hedge funds and then private equity. And so all this different conglomeration. And now we find ourselves, really in the throes of a huge boom in ETFs and other product wrappers. And we haven't even discussed, crypto or some of these other ancillary types of things. And so, to start at any one point with such granularity, I think can be a distraction from the bigger picture. And so before you got into the financial crisis back in 2007 and 8 and 9, a lot of people would say, okay, well, we're equity folks, or we're fixed income folks, or we're interested in the commodities markets, and they would go down their pathway. And very few people paid particular attention to macro. But there was this crystallization between the advent of the global macro hedge fund, which was really in the early 90s, and then the financial crisis. That 15-year window sort of gave rise to macro. And then once the banking crisis happened, people said, oh, we need to reverse this process. We need to start with a global view. We need to understand the big moving parts. And then, like anything, if you want to pull on a thread and go down a rabbit hole, you can do that. And so I think macro has had a little bit of a renaissance, a little bit of a rebirth in the last 15 years. We've been very fortunate from a firm standpoint to just sort of run concurrent with that. We didn't push it, but certainly.
But it seemed very new at the time.
It did.
You were onto the macroeconomic and thematic investing.
Yeah.
Early in the game.
Well, the key though, Deb, is so we can talk about the economy, for the next hour if you want. But at the end of the episode, your listeners are going to say, "Well, that's great.
Do?
What do I do with that?"
Exactly.
Right. And so if you're all of a sudden going to graduate your viewpoint from the ground level to 30,000 feet, you at some point have to come back down to ground level when you implement it in the portfolio, right? And so that has been, in our view, the sort of the trick of the trade, if you will. And from our vantage point, that's really where the macro theme becomes particularly important, because then when you have a theme, you've got an ability to sort of dial in on that.
And as an advisor, and having worked with you through this transformation, there was always a point early on where, because I love the research so much, I was hoping for it to become actionable, and now it is.
Yeah.
And it's very exciting.
Yeah.
So can you tell me a little bit about, when we say macro thematic, and particularly the word thematic, what does that mean in Strategas terms?
Sure. So we'll back the story up a little bit. You've got two sort of good points of discussion here. I'd say from our vantage point, so we launched this macro research firm. We're looking at the world from a holistic 30,000 foot view, and we sort of take the realization that we need to get slightly more granular. And so does that mean liking a particular geography, a particular asset class, maybe a subset of that asset class, like tech stocks or industrial stocks? And very organically, our clients would ask the question you posed a moment ago, which is, well, how can I do that specifically? And then ultimately, can you do that for me? Right. And so that was sort of the graduation of our process from 30,000 feet all the way down to the ground floor, so that it becomes a total offering. And then the thematic piece is really, I think, the articulation of macro conclusions. So, if, as they say, if it's raining in Brazil, buy Starbucks. There's something that's happening way over there that is going to have an investment conclusion way over here, right? And so we think of it as little vignettes. What are some of the major themes that people talk about? And that's how questions come from clients through advisors and to us. Hey, tell me about AI. What do I need to know about artificial intelligence? And so that question comes to us, and we do our level best to understand its implications, and then ultimately turn around and say, gosh, we think there's something there, and here's how we might invest in it specifically. And so the theme really takes all of the macro inputs and puts it into this little box that is easy to digest. And then you can have a series of themes. You can get rid of a theme if it loses steam. You can add a theme if something evolves, but you're not beholden to one particular outcome or solution.
And if you're just on the ground floor picking the assets without that guidance of the macroeconomic theme, then you could be realizing that there are 11 sectors, and some are going to do better than others. And one thing I've loved about your firm is that you don't feel the market always looks the same.
Right. Yeah, it changes. And you mentioned the 11 sectors, and that's just in equities, right? And then you've got lots of other considerations. But the thing that I like about thematic is it is the most appropriate marriage of the top-down macro and the bottom-up considerations that go into picking any particular security. So once you sort of distill the bucket and say, okay, now we're going to focus on these 20 stocks or these 30 stocks, but there's a reason that we're focused on these, that exists in the geopolitical environment, that exists in the monetary policy environment, that exists, as a mosaic of all these other things. Now we're going to focus on these for a reason. Then you can pick from among those 20 or 30 names the ones you like the most, or the ones that meet the criteria that you and the team have sort of laid out as being appropriate for your clients. But to start there is a universe of securities that is almost untenable to try to keep track of. Yeah.
And so now you're able to get that expression through, you've built it out. So now through ETFs and through separately managed accounts, you've got a lot of optionality.
Yeah.
that you can express that thematic, and it's very exciting.
Yeah, it's very fun.
So as we look at the firm, 2006 to present,
Yeah.
that's a long time, even for a young guy, to be at a firm. What is it about Strategas? What is it about the culture that retains and excites people?
Yeah. Strategas is a special place. And I say that not because I was there on the first day, but it really is a wonderful group of people. You mentioned accurately that it is somewhat of a long period of time for one person to stay in one place. But we've got 5 senior analysts. The most recent addition to that was hired in 2007. So 3 of us started
Wow.
in 2006. We hired 2 of them in 2007. They're all partners of the firm now, names along the way. And we just enjoy working with each other. And I think as much as we enjoy each other, we also complement each other. We are different in the way that we think about the world. We're different in our temperament. We're different in our interests. And I think we've recognized that commercially, that's actually a really good recipe. Nobody's sort of stepping on anyone else's toes. We've got some folks that are inclined towards, big thinking and walking the streets and talking to, every guy and gal on the street and sort of picking up the ephemeral elements. And then we've got, other people that are in the weeds and sharpening their pencil with their calculator and doing some of the math. But it all comes together in a really nice package. And we do put an emphasis on, who we hire and who comes and works with us. And I know that that's what every HR department says, but with 55 people, we can't afford a bad hire. So we've been very, very fortunate in the people that have joined us on the journey along the way.
When I've come into New York and spent time in your office, I always feel like I'm in a learning cafe. Everybody seems to be walking around, excited, collaborating, sharing ideas.
Yeah.
And so you spoke to hiring.
Yeah.
And what is it that you find? You seem to find precious gems.
Yeah.
But what is it? What are you looking for when you're looking to add someone?
So my own view is that, and again, the fellas might answer this differently. Eileen Gabay, who runs our firm, might answer this differently. But I think the single core element is curiosity. Like if you're not curious about what it is that you're sort of doing, right, which invites a thirst to inform and a thirst to learn and an interest, and it invites a lot of other things. Curiosity. Everyone at the shop is interested in why. That's the question. Why that? Why this? And so we find those people because it's not just about the school that they went to, the courses that they took, the places that they worked beforehand, or the experiences that they've had. It's that they have a genuine curiosity. And the thing about macro is it's global, right? I mean, you can come from anywhere, but it's all relevant. And ultimately speaking, we've had mercifully very few misses along the way from a personnel standpoint because almost everybody we've ever worked with has been super curious about why.
Intellectual curiosity and also just this willingness to accept new information. I mean, it's fairly easy, I think, in the investment community to be very sure of what you're sure of.
That's right.
If there's not a lot of collaboration, and if it's not an open vessel, then I noticed that about all of your people.
Well, we love, one of the things that is important. You mentioned it. We love having you in, and we love having all of the clients who come through town in, because we learn something new. And so we make a very real sort of practice of inviting folks to come, particularly to our morning meeting, just because it's a more convenient format of gathering the whole team together at once. But during the day and sitting with folks and learning about little pieces of geography that we're not necessarily focused on in the moment, or little pieces of the investment landscape that we're not focused on. So we learn from our clients as much as we hope we offer our clients in return. And again, it's just a general curiosity and a thirst for information.
A great exchange is going on. And I think you mentioned that at one time you thought you had more interns than employees at the firm.
Yes.
And,
well, the interns are a great, I think I was very fortunate to have a couple of really great intern experiences myself at both small and large firms.
Interesting.
And so it was part of my own discovery to figure out that I actually like the small firm format a little bit better,
Okay.
But interns are interesting because, obviously they want to, make their way in the world. They want to sort of, get themselves into the industry of their choosing. But you can tell very quickly, as you may know, just in how they comport themselves, that the intern that shows up on the second Monday is the person that they will probably be for their entire career, right? And so that individual, if they spend the next 3 or 4 or 5 weeks with you, curious, engaging, willing to sort of take it on, willing to listen, willing to push back, which is important. Not everybody who's been in the business longer knows more than somebody who may be younger. So we learn a lot. One of the wonderful discoveries we made from interns was all about social media. And all of a sudden, these kids are on lunch break or they're walking and we just, hey, what is that? What are you doing? And they just gave us life tutorials on social media. And we recognize that as a really important theme.
Yeah.
And then you go down the rabbit hole on that. And so you can learn from anybody.
It's incredible.
Yeah, it's great.
I mean, there's something about the culture that is very special.
You're very nice to say.
Clear from the beginning.
Thank you.
Your history at the firm has really been rising. You've grown through the firm.
Yeah.
Starting out, you had background at FactSet.
Yep.
You had background at Morgan Stanley.
Yeah.
But most of your career has been at Strategas.
Yep.
But your role has really grown over time. And so tell me about how you spend a typical day now.
Well, a typical day, mercifully, there aren't any, which is great. The only sort of consistent thread to it is that they're generally either related to my family or related to Strategas. Those are the only two consistent threads. But, your point on the evolution of my, we'll call it portfolio of responsibility, is really a function of sort of three things. Number one is my own interests have evolved along the way. My position at the firm, and I don't mean that to titulate, but I just mean in general, affords me the opportunity to sort of change what I'm focused on. And then the third, which is really the most important from a business standpoint, is that the global economy changes. What we're talking about changes. I used to make a joke when people would ask me about themes. I would try to break it down very simply. I said, well, gosh, if there was another, SARS outbreak, these are the 8 stocks I would buy. Well, who was to say 11 years later we had a global pandemic and it became a huge thing. So things changed, financial crisis, COVID pandemic, politics changes, the world changes, and so all of those things have allowed me to sort of evolve what I'm focused on. But at the other point of it is I'm very curious, right? I have a general curiosity, as we mentioned, for things that I know nothing about. I'm genuinely interested in knowing about things I don't know anything about. And then I have a very specific curiosity in the things that pique my interest to say, hey, let's go get a little bit more on this. And so early in my career, it was much more technical, like why does math work? Why is that valuation mean?
And an MS in mathematics.
Yeah. I mean, ultimately it did manifest in going back to school and getting a master's in that. But the curiosity was really the foundation of it. And now my interest, because with that foundation, now my interests have evolved to other areas. And so you think about geopolitical conflict, and you're learning about history, and you're learning about culture and society and religion and those types of things. And it's not to be preachy; it's to understand the context.
And that one informs the other, informs the other.
Yeah.
And that is what's amazing about the macroeconomic.
Yeah, I mean, it's like in life and in business and in investing, you've got to be present. And you've got to have context. And if you are present and you have context, then you can afford to be curious. And then I think, modestly, because you'll be wrong, you can make good decisions. And if you can, if you make 51 good decisions out of 100, you're in really good shape. And you also, to your point earlier, and I think you and your partners have espoused this, and there's other folks I've met along the way who do, but not everyone, right, is you have to have a little humility. Is you're going to be wrong,
Absolutely.
And so when you're wrong, you have two choices. You can accept it or not accept it. But it'd be interesting to accept it and then try to figure out why, right? So you don't, find yourself making those same mistakes again.
Fail forward.
Yep. Yeah.
So being it's the beginning of the year.
Yep.
And you begin with that macroeconomic view of stocks and bonds in the public markets, and we can talk a little bit about private versus public in a few minutes. But right now, as you guys sit in a room and you're always sharing, and I love that about the firm. If we were looking at some things that you think are the most important themes going into 2025, and what maybe after 2 blowout years in the market, we're now in year 3, people are wondering, what's the outlook? and what do we need to be thinking about as we look at our portfolios?
Yeah, as we move into 2025, I think you finish your question with the starting point of the answer, which is we've had two blowout years in the equity market. So if past is prologue, history would say that's unlikely to happen a third year in a row. Or if it does, it's unlikely to happen at the same order of magnitude. It's not going to be as great a year. And so is it just fatigue? Because fatigue's okay. You can get tired and sort of still be in the race and still want to be inclined towards an optimistic outlook. You just have to recognize that, it's going to be a slightly slower pace because you're fatigued. Or is something changing, right? And so that, to me, is what makes 2025 really interesting. And so we have, just to make it simple, we have a generally positive outlook for equity investors as we move into the year.
Okay.
But the fixed income market is telling you something is not entirely right. It's giving you a little bit of a mixed message. On the one hand, you look at something like the 10-year Treasury, which has been flirting with this 4 to 5%, or in this 4 to 5% range, and now has sort of moved to the upper bound of that, right? So it's through 450. It's thinking about 475, and in the last 3 or 4 years, that's proved to be a little bit of a gray area for equities in response, a little bit of a red line, perhaps. And so I think you want to understand why that is. I think one of the facets of that is that the Federal Reserve, right, when you think about monetary policy, may not have the ability or the air cover to be as to remove the accommodations that they had put in the last couple of years as much as they wanted.
They have pulled out all the stops.
They've pulled out all the stops. 3-4 years ago, 3-4 months ago, we were talking about the market was pricing in 9 Fed rate cuts for the end of 25 and end of 24 and the beginning of 25, and now we're barely into January as you and I sit here, and they're talking about maybe it's over. Maybe this is the end of the Fed cut cycle. Well, so why is that? Well, is the economy starting to see a little bit of slowness? Is inflation starting to pick up, rear its head again?
And you've talked about waves of inflation. I think people think it comes once and it goes. But it occurs in waves.
Yeah, it does occur in waves, and I think we want to be particularly mindful of that. Don Rissmiller, who you and I know well, who's our chief economist, and his team did what I thought was really a very interesting study about a year and a half ago, where they went back and looked at developed economies. Now, it happened to be over a 400-year period, but developed in the time. And they found about 90 instances in which these developed economies had annual rates of inflation of 6% or more. So we sit here and talk about 2% or 3%, and we're like, oh my goodness, this is untoward. 6% inflation on an annualized rate, and in almost all of those cases, to your point, inflation played out along multiple waves. And I think it's really a function of two very simple principles. Number one is that we measure inflation on an annualized basis, so year over year. So you're never more than 13 months away of changing the direction of the measurement. Even if the level of inflation itself isn't actually changing, you're changing the measurement because you're anniversarying the problem, right? It's far enough in the rearview mirror, 13 plus months, that all of a sudden it looks like you've improved inflation. So in the United States, inflation went from 9 to, call it, 3. But the level of prices still remains elevated. It's still 20, 24% higher than it was now 2 years ago.
The consumer is saying, what do they mean? It's come
and so
so
you
far
have there's
down.
impacts for the consumer, and then the other component of this, and this is why the second wave generally evolves, is that policymakers don't take the requisite steps to solve the problem. So we've not, and this is not a political argument. It's not meant to offend anyone's political sensibilities. Democrats and Republicans alike are guilty of it. Political stripes in other countries are guilty of it as well. Are we going to cut spending? Are we conditioning ourselves to perhaps spend less? Are we going to raise taxes? Are we going to, are we going to find some productivity gain that will alleviate us of this inflation? Well, that's tough to do if you're not investing, right? And so what ends up happening is you've got the fourth outcome, which is inflation. You have to inflate your way, and so inflation comes back in. And in our economy, in the developed West, and in the United States in particular, we have a very contractual economy. We have leases on apartments. They're a year. And then when you re-up them at a higher price, that's another year. We have a lot of the unions are getting in the news nowadays for big wage increases, not perhaps undeserved, not unearned, but large all the same, and all of those things permeate into the pricing landscape. And then of course we've changed the way that we consume and produce energy in this country in the last 4 or 5 years. We've changed the way that we access agricultural products. We've changed the tenor of trade, going back to President Trump's first term. And so all those things just compound. And then we just injected, trillions of dollars into the system. So that's a recipe for inflation, and we've not really taken our medicine. So I think we want to just be simply on the lookout for inflation. And the average individual, who gets in, or I shouldn't say the average, the individual gets in their car every morning to go to work and gasses that, puts gas in their tank or goes to the market to put food on their table, are recognizing these higher prices.
They are feeling that.
They're feeling it.
With 70% of our economy dependent upon how the consumers feel and what they spend,
That's right.
becomes more important here
That's right.
than a lot of places.
Yeah, it's tough.
So, and it is hard to know, but at its base, if we get higher 10-year rates for a longer period of time, historically that hasn't been as good for the market
Right.
as when rates are low. We've had this nirvana, kind of a platinum age with interest rates being so low for so long. But you mentioned the different forces, and I'd like to talk about the relationship between energy and AI.
Yeah.
For a couple of minutes,
Sure.
if you can. I know that's an area that you know much better than I, and but being in the energy capital,
Yep.
and with AI seeming to require unfathomable amounts of energy, how are you looking at that? And is there an investment approach that makes sense?
I think you're right. And what's interesting about AI as a starting point, right, is that it's been around and in developing for 40 years. Right? There's some really wonderful little history narratives to be read about machine learning and the evolution. This didn't just occur overnight, one day, 3 or 4 falls ago. And so I think AI is really going to be a narrative that's with us for 10 or 15 years, and in different sequences. And the first sequence was just sort of understanding and graduating what exactly the utility was, educating, and then ultimately, foisting some commercial application onto the public. So you see it embedded into all the softwares that you're using now. It's in your internet searches. It's in the software you use to
That
conduct
ramp up
your
was
business.
fast.
Very fast. And I think when you sort of get under the hood a little bit, you come to understand that it's predicated on largely on these large language models. This is what we're talking about, generative AI. And that requires just a tremendous amount of metadata. So as a completely side discussion, that can help explain the Mag 7, right? Because who really owns enough metadata or has access legally to enough metadata that they can build a large language model? And there's very few of these hyperscalers globally. There may be 20 or 30. There'll be some some NGOs, some non-government organizations. There'll be some companies like we know out in Silicon Valley, the Mag 7. There'll be some globally, universities, things like that. But there's not many of them. But then all of a sudden, these companies themselves, and I think what's really illustrative to your question about power, is that the CEOs of, call it the Mag 7, but that sort of sleeve of hyperscalers saying, we have a power problem, right? Is that it's so energy intense to generate this commercial solution that we actually have to take our eye off of the development a little bit on the technology side and come over here and focus on the power side. Now, what's interesting about this is that over the last, as you know, as 25, 30 years, we've had a power problem in this country, right? I mean, we've been...
It's never quite been addressed.
It's insatiable, our increased demand for it, number one. Number two, we've come to live, far more technical lives that require more power consumption. And then this has just sort of supercharged it. So we think AI, as we talked about a moment ago, or maybe a few minutes ago, is an interesting theme, and it's now moving into the quiet period, and I'll come back to that. But what has completely come off the side of AI, is the industrial power renaissance. It's more than just a particular company putting a micronuclear plant in a place and then building a data center next to it so that they can turn the lights on 24/7, 365. It's about addressing our total power needs in this country. By that, and when I say alternative energy, I don't mean specifically the environmentally friendly. And so part of this is to get the political discourse to be aligned, right? Obviously, President Trump in his first term and President Biden in his term had very different views on energy and natural resource consumption. Now you're getting to a point, and I'm not suggesting for a moment that either of them were right, but now you're getting to a point where there's a very bipartisan thread of discussion within Washington where we need more power and we need more of all different types of power. And there's going to be room for alternatives. There's going to be room for traditional because no member of Congress wants to be the place where the lights go off. Moreover, it's an opportunity because you have, as has been made aware through talking about some of the drug pandemic and endemics in the United States, there's been a carve out of the industrial Midwest. There's been a carve out of a lot of different places that aren't in the Southeast or aren't on the coasts. A lot of migration has gone through COVID, but you have the infrastructure in the middle of this country to not only build power facilities, but to build large data centers, to revitalize the economy. So now you're getting members of both, stripes very interested in making those investments here.
Well, that behavioral change was really important because I think we always thought we put tech over here in the green compartment, and we put energy in the other compartment, and ne'er the twain shall meet.
Agreed.
But now they are really dependent on each other.
They have no
the
choice.
First time.
They have
no choice. Exactly.
Yes. And I think that's, again, not to get political, I think that in a way is illustrated by some of the political migration of, West Coast tech folks toward Trump. And it's less about embracing Trump for Trump. And that may be a separate episode, but it's more about we need power and this guy wants to drill.
Right.
So the path of least resistance for me commercially is to take all the good with the bad, right? And just get the power that I need. And then if I'm in the room, maybe I can influence some of this other stuff. But the real focus is about power.
And the conversation about AI has often centered around the Mag 7. And it's worth noting that in one of your thematic funds, which outperformed the S&P in 2024, you had virtually no Mag 7 in it. So how is this theme investable? Tell us.
Yeah, it's so this is the evolution of AI, which I think is one of the really important lessons that I think industry, I'll use tech generally, industry learned in the late 90s. And you'll recall everything with a .com on it, Nick.com, Deb.com,
right.
They all traded at obscene multiples.
Yep.
Right. But virtually none of them are in business anymore. But the infrastructure with which the internet runs is 30 years old because it was started in 1995. It went through the late 90s and it's 2025. So it's 30 years. So it's got, the fiber optic cables have gotten larger and the broadband's gotten faster and all that. But the baseline infrastructure has been in place for 30 years. And so the lesson that industry learned and has now applied to artificial intelligence is we've got to get the foundation in place first. So we need to solve our power problem. We've got to solve our location problem, and we've got to solve our computational, compute problem, right? And once we get that, then my little company can come up with the widget or the app or the commercial application that I can sell for a higher price or that is, more adopted by the consumer. And so that'll be the second phase of AI. Right now, industry's focused on the skunk works. Industry's focused on the infrastructure. And that's why power has become such an important thing. So the answer to your question from our standpoint is if all of these big companies are spending to bulk up, if you will, to lay the seeds, to lay the infrastructure, where are they spending it? Yeah, one answer is a chip company, who obviously has taken a lot of mind share. But along the way, it's every industrial operator that's building all these data centers, right? It's all the utility companies that are transporting, and helping to compute the power. So there's a lot of little ancillary components to this that have done very, very well. It's all the computer parts, operators, all the things that go into building those different components. And if you just, again, use that macro lens to zero in on a particular group of 20 or 30 stocks, then you can find the names.
Obviously, you're absolutely right, but
Yeah.
it's so interesting that most people just want to make a beeline to, okay, what is the AI company?
Yeah.
What's the one little gem? And it's so unbelievably interconnected.
Yes.
And this is another great example of how that macro view
But to
becomes so important.
your point, Deb, and I would say to bring it back, this question to a question you asked earlier about the macro outlook for 2025, is you've had 2 years that were, let's just say, easier than not to generate a good return. Now, whether you outperformed or underperformed by a couple hundred basis points, the client can look at their portfolio and say, it's still up.
And I feel
and
good.
I feel good, and maybe I've got some other issues at home.
And the equity in their house.
The home is worth money. Now, maybe I'm annoyed when I have to fill up my tank, or I'm annoyed when I got to put eggs in my basket. But at the end of the day,
restaurants,
it's okay. But here's the issue about 2025, which is why I love AI, which is why I love the industrial power renaissance thematically, why I still like deglobalization, is that now you can't rely on 7 or 10 names. You are forced to do the work to find the ones that are sort of upcoming, that aren't fully priced in, but are integral to getting the economy to develop AI further, to answer the power question, right, to help us navigate the global geopolitical, economy. And that's where this granularity, sort of a broader portfolio, a portfolio where you've got 3 or 4 themes, but very focused on things, can help inoculate the performance against maybe a market that gets a little softer.
I mean, it's an interesting way to look at risk management, because I think a lot of people think that the S&P index is a safe bet.
Yeah.
But do you think it's possible that it's become riskier?
Yeah.
With the concentration.
Concentration. I mean, the Mag 7, if you will, are more than 40%.
Is it 40 now? I know it
index.
just keeps running.
It just keeps going and going.
Yeah.
And so I think what happens is, and we've had this, if you were a fly on the wall in the morning meeting the last couple of days, you would have heard this conversation, is that there remains this real argument about active versus passive.
I'm glad you're mentioning it, because I would have next.
But
Great.
this is, and you and I have talked about this for a long time, not just this morning. There is a difference in terms of the product that you use to gain an exposure, and let's say an ETF, versus how you use that product. So one of the things when we were talking to advisors about exchange traded funds and launching our small suite, I'd say, well, what do you like about ETFs? And they say, well, they're single CUSIP, so there's an ease of use. It's one security in the portfolio, in the account. And I like the tax, number one. And number two, I like the tax efficiency. Okay. So I kind of put that on a shelf and come back to it, 10 minutes later. And I said, well, how are you using them in the portfolio? Well, we trade in and out of them. Well, if you trade in and out of them, right, you're losing the tax efficiency.
Absolutely.
Right? Because you need the hold period, right? So that helped us develop this idea, which was just completely in line with the way that we do research of thematic rotation. So we'll give you one CUSIP, right? But you can rotate through the themes across the year. And so whether you ever invested with Strategas or you sort of do it on your own, the idea here is these themes will change. And it's not just rotating, it's finding the ones where there's thematic momentum. And so when you look at the broader economy, the themes will evolve as you move into 2025. And then within themes, the stories will change. So deglobalization, right, which before Russia's invasion of the Ukraine, I would have been hard pressed to define it. If you asked me what's deglobalization, I was like, Deb, I don't really, seems kind of academic. But once Russia invaded Ukraine, unfortunately, it crystallized a lot of disparate sort of sub-themes, which is deglobalization is the fraying and the breakdown of long-held, reliable geopolitical operating conventions. Now, if anybody else ever says that to you, they're trying to sell you a book. But break that down to its component parts. It's defense spending. It's IP procurement. It's energy procurement. It's international relations. It's tariffs and trade, right? And then ultimately, it's labor. It's populism. And so all of those little threads will evolve, but deglobalization is just kind of talked about in the news. But each of them is really very investable.
It's the Panama Canal.
It's the Panama Canal. It's Greenland. It's the Panama Canal.
Exactly.
It's the Middle East. And it brings us back to what we talked about earlier about religion and society and culture. And it's not to sound highfalutin or overly academic. It just brings us back to what you and I have talked about for years, which is context.
Right.
That's
and being long-term in thinking, but active in the way that you approach that. And so a lot of people think that you can't add any value with active management.
Right.
You know, that the ongoing debate between passive and active. When we talk about active and the way you think of it, first, just in general, some of the stats don't favor active management, but if you look a little deeper, others really do. Can you speak to that a little bit?
Yeah, I think that the statistical profile for active versus passive is, I think the statistical profile of active versus passive is challenged by looking at all the data as though it were one person's portfolio, right? Because at the end of the day, let's just pick on the S&P 500 because it's the index. It is an actively managed basket of stocks, right? It's not the same 500 companies. And so the committee at Standard & Poor's changes the constituents. It's got a fairly high turnover, right? So you are, in a way, actively...
And higher than it used to be.
Much higher than it used to be because of, appropriately, the changing composition of the economy. So my view is that if you were to look at, in very specific instances, at a type of investor, say, the young family getting started trying to save for their kids' education, or the retirees, who are, selling house and maybe moving to another state and taking some tax and weather advantages. Those are very different risk profiles. And so when I think about active versus passive, I think the first thing we want to consider is the risk profile of the investor. And I would actually start on the defensive side of the ball as opposed to the offensive side of the ball. So what are we trying to accomplish? And where are we trying to skate to? Where do we think the puck's going to be when we get there? So that's the first part. Then the second part is trying to figure out, whether it's thematically or otherwise, where do the opportunities lie, right? So if I know that my risk profile has a lower tolerance for a certain type of asset class or a greater tolerance for a certain type of asset class, that will allow me to expose myself to those themes differently. And so one of the interesting things about ETFs is that active exchange traded funds are now about 8 or 9% of the total, right? Well, you've got two competing forces. Number one is you're measuring just the sheer growth in funds that are allocated to the index and the Magnificent Seven, and that's growing passively. But the other part of it is, how is the advisor using them, right? So if you're trading different passive products, you're just actively managing, albeit at a different threshold.
Good point.
And so what we're trying to accomplish is to allow you, either through our suite or other suites, to have one or two things that are accomplishing your long-term goal and allow the themes to rotate, within them, as you would watch the evening news. It's always at 6:30, right, in the old conventional sense, but the stories change every day.
And the actively traded ETFs are about to just take off. They're only 8 or 9%, but every time I speak to someone, they're starting a new actively managed ETF. You've been doing this now
for a while.
Yeah. And I mean, it's great to be an early adopter.
Well, it isn't. Yeah. I mean, there's benefits to it, but I think
there really are.
I think that your viewers in particular would be interested in, understanding the evolution of ETFs, right? So, the spiders, right? The SPY, was really the first real exchange traded fund. It's 30 years old. This isn't just come yesterday, right? This is 30 years old. But what's important about ETFs, and I think there's sort of, three big, buckets. There's passive, and that has been accumulating assets for 30 years, right? So of course it's bigger, right? Then there's another sleeve of exchange traded products, and I emphasize the word products as opposed to funds, which are focused on things that historically have not been available to retail consumers. It's access to the commodity market. Let's say you buy gold or silver or platinum. It's access to the currency market. It's access to different credit products. So now it's about retail access points. All of a sudden, as you know, earlier, when you was first starting out, you couldn't buy gold easily for your client's portfolio. We are here in Texas, of course, so a lot of your clients would have exposure to the energy market, but the average investor couldn't have oil exposure in their portfolio. So these ETPs, these ETNs, exchange traded products, exchange traded notes, they make that very available, right? So that's another basket of passivity where you're either in gold or you're out of gold, you're either in oil or you're out of oil, right? But you're gathering assets that are alternative to the traditional portfolio mix of stocks.
But they're
and bonds.
still publicly traded.
But they're publicly
and
traded.
You're not paying 2 and 20.
Right, but they count as passive, right? Because it just owns oil, or it just owns gold, right? Or it just owns the dollar.
Yeah, good point.
Right, so it's not really passive like you're owning the S&P 500. It's a different flavor. Right. And then the third bucket, which is where I think we're talking about in terms of active, is I think it's thematic. I think it's macro, and I think it's stock selection. We don't do all of those, but that's the bucket of opportunity. And in my own humble opinion, I think the ETF is a superior product type to some of the other product types that investors have used historically. And so there's also a migration that's happening. So you see industry, some of the big names in Boston or Baltimore, or Los Angeles, San Francisco, big Chicago money managers are moving from a different type of product wrapper into this new product wrapper.
Absolutely.
And that's really the growth. The strategy's the same. The manager's the same.
They're still stocks.
It's still stocks. It's just the way it's still bonds. It's just the way they're put in your portfolio is different. And so that invites, and this is sort of the last piece that makes all of this fascinating, that invites a re-examination of how during this big generational wealth transfer, we accomplish what we're trying to get to. Again, it's the same question that Gretzky asked or answered, is where's the puck going to be? And that's where I'm skating to. And so you're changing the product type. You're changing the access point. You're changing because of the nature of the pandemic and the financial crisis and the pandemic, et cetera. You're changing
deglobalization.
Yeah, and globalization. You're changing the way you construct a portfolio. And we have, by dint of technology and other instruments that we've developed as an industry, a greater appreciation for risk. And so it's impossible to do what you were doing 10 and 20 years ago for the next 10 and 20 years when all of these things have changed. And that's why macro is important. That's why thinking thoughtfully about some of these issues is really critical.
And you have a fairly large team now. You've evolved, and how many people are in the asset management group?
Yeah, so we have 55 folks at Strategas, and some of them pull a little double duty, but we've got 7-8 folks just focused on asset management. Right. So, they're taking in everything that the firm is doing, but at the end of the day, they take 30,000 feet and they get it down to the ground floor. And so they're focused on the stocks once the theme has been identified. They're focused on whether we should change those stocks along the way. They're focused on whether themes should change or evolve along the way. It's fascinating stuff.
Very exciting. Yeah. And I think that, for people who think that active management can't really add value, you guys are a great story in terms of how putting it all together does accomplish that.
Yeah.
So as we look at 2025, I'm not necessarily saying, okay, what's the best and what's the worst, but you don't love all 11 sectors equally.
No.
So if we were looking at portfolio construction from your standpoint, what are the ones that we'd run toward and even potentially some we would run from?
Yeah. So I think there's the first question we need to answer is what's our time horizon? And where we sit right now, not because it's January or the start of the year, it just happens to be, I think, the underpinnings of the market right now is you have two sort of competing trends. You have a longer term trend, which is very bullish, and we believe very much intact. It's very positive, where the market is generally going up, generally pro-growth. There's generally a belief that the economy is okay. It's not capitulating into recession. And that's a trend that we want to generally be on. But we have to be very aware that there's a shorter term trend. There's a trend that's evolved into the latter part of 2024 because you've had 2 great years in a row. So there's some portfolio adjustment that's taking place. Because you're at the beginning of a new year, so there's a portfolio rotation that's taking place. And you've seen some of those cyclical areas of the market. You ask about sectors, you talk about technology or industrials or the consumer, where you've seen a little bit of momentum roll over. So the question is that the beginning of a change in the longer term trend, or is it really just an adjustment? And so I think we can look at a couple different areas, try to glean an answer on that. So number one is you're not seeing any real positive activity in any of what you and I might describe as the defensive corners of the market, right?
Right.
The utilities, the staples, the healthcare. We're not seeing an overwhelming institutional interest in those areas, and we're not seeing an overwhelming retail interest in those areas. Now, utilities has, obviously some episodic opportunities as it relates to the industrial power renaissance, to be sure. But en masse, if you just think about what the utilities have historically been, they're
Well,
not.
and en masse, it's been a risk-on outlook.
Yeah, and
just in terms of
right. So there hasn't been that interest in the defensives, right? So that's number one. Number two is what I think, and my partner Chris Verone has long used as just a really simple, measurement, real simple barometer of risk and risk appetite is equal weighted consumer discretionary stocks, performance relative to equal weighted consumer staple stocks. And it's just recently broken out to a new high in favor of the discretionary. So it's pro-cyclical, right? So I think when we think about this year, we want to remain cyclical. And the only thing we want to take the temperature of, because the labor market is generally strong. There's some, there's a little bit of weakness at the fringe, but it's generally strong. Is we just want to watch that inflation piece, right? And if it does come to rear its head again at the end of 2025, at the beginning of 2026, it will have an impact on the consumer, right? But what's also happening, which is just interesting, we haven't really gotten to talk a lot about energy, the classic energy, is that prices remain low at the pump. So generally speaking,
it's been surprising, really.
It's been surprising. It's counterintuitive, perhaps, to what a lot of folks, not in your town would know, but just out in the general world would know. But that's effectively a tax cut for the consumer, right? If I can get from here to there for less, right, then I have more to spend when I get there.
Yeah,
and that's effectively what's
we saw the
been
pain
happening.
when we see some surges. We see the pain.
The pain is very acute.
Yep.
And it hits all corners. And mercifully, knock wood, we've not evidenced that. And one of the things, and again, people will paint political. You'll take their political views and sort of paint where success and fault lie. But I really believe that the fiscal situation in this country, married with the monetary situation in this country, and the fact that we have actually changed the party in power in 10 of the last 11 national elections, right, has actually forced us to ride a middle line. We've not had the luxury of, successive 8-year presidencies where, or demonstrable majorities in Congress where it swings way out to the left or way out to the right. We come back to go the other way with such frequency that none of this stuff get entrenched. Yeah. Now, socially, some of those other things.
Different.
But again, those are all happening, at the media level in how you consume the news. The bedrock economy stuff, the rules of the road, the way industry is managed, has basically followed a center line because every 2 years the parties in power change. Every 4 years the parties at the White House change. We still have to find what the right long-term solution is. It doesn't absolve us of a solution, but it's actually made navigating the financial crisis and navigating the pandemic, I think, more tenable because we didn't swing so far out to what could have been a bad decision. It didn't allow us to get to what could be a correct decision either, but we basically mitigated and we risk managed the economy through a central tendency of trying to go too far to the right, trying to go too far to the left.
That gives us a pretty good foundation going into this year, which is a little bit different.
Yeah, and Americans should take some confidence that the system works. You may not agree with where the system is parked for the moment or where it will be or won't be, but
that
it works.
has been the silver lining in what may have turned out to be disappointment on either side of the aisle, but that has worked.
Yeah, and I think at the end of the day, and this is a little, this gets a little too far into the weeds, but the way that we adjudicate monetary policy in this country is really critical. And you can, when you think back to the financial crisis and the way that, Chairman Bernanke, was sort of at the table and the way he, moved the Fed in that direction. And even, Secretary Paulson, albeit from the administrative side, that's a wholesale difference from what then Chairman Yellen and Biden Treasury Secretary, and now as Biden's Treasury Secretary have tried to do, and Jay Powell. But it's the same institutions. It's the same U.S. Treasury, right? It's the same Federal Reserve. And yet in the course of 15 years, even though the policy has generally looked like it's one directional, the economy with which they're trying to navigate, I would argue, is decidedly different. So I think to that end, at the end of the day, the navigation of the monetary and fiscal policy has allowed us to sort of run in a straight line, right? And the Fed is, was overly accommodative in the crisis, overly accommodative again in the pandemic, and now they're trying to reverse course and be slightly more restrictive without toppling the economy because of inflation and some other attendant concerns. And at the end, you ask about 2025. So I think if we look at 2025, we could say we almost seem like we're in permanently late cycle. And I actually think that that's a really enjoyable place to invest because you don't gravitate to the hot flame of a news cycle, which we've enjoyed the last 2 years, but you're not totally dependent on inoculating the portfolio against recession or, pullback. And so you can be more specific. You can think thematically as we would be inclined to be, but you can think about the pieces of the portfolio. And ultimately, the economy sets up very, very well for that.
And rearrange the puzzle a little bit, but in the end, you feel like we're in a pretty good foundational spot.
That's right.
That's good to know.
That's right.
Okay, is there anything I should have asked that I didn't about the economy or?
So the one thing I would that we haven't really touched on that I think is going to be important, and it's not a fun, sexy topic, but everybody, unfortunately or not, has this in their life, is taxes. And 2025, just by dint of the way the code has been written over successive presidencies and Congresses, 2025 is shaping up to be really the most important year for tax policy in this country since 1913.
Both income and estate.
All of the above. Yep, all of the above. And so 1913, we implemented the income tax, and in 2025, we're going to examine the whole code. And it's going to be substantive. And there's a lot of moving parts, as you might imagine. Notionally, of course, it's far larger, but just in terms of the totality of it, incoming President Trump certainly has a bias because of the anniversarying a lot of the keystones of his his bill from his first term as president. Obviously, Democrats in Congress have other considerations, but you also have geographic considerations, right? So you've seen a migration away from, in particular, New England, where I live, towards the southeast. You've seen it obviously from certain states on the West Coast, migrating towards Texas and other states. So there's state tax issues as well.
Fascinating, isn't it, that there are only 2 states with positive migration, Florida and Texas.
Yeah. And what's the commonality other than where they sit, on the longitude?
It's a tax.
It's the taxes. Yeah, exactly.
Right. So the 2 things that people are most interested in, I think, are what's going to happen to salt.
Yeah, salt's a tough one, and this is a situation where I don't think it's along party lines. Now, the vast majority of congressional seats in New England are held by Democrats, so there's very few Republicans up there. But they've also recognized that a lot of the reason that folks are leaving the area is because they no longer have that salt deduction. But because the nature of Congress being so tight, and I mean, Speaker Johnson enjoys, quote unquote, a 3-seat majority in the House, salt's going to probably could end up on the chopping block at the very end of the day because they still have a deficit problem, and it's a big ticket.
It is a big ticket item. Yeah. Okay, and then from an estate tax point of view, we are facing the sunset as $83 trillion is going to transfer from one generation to the next in the upcoming years. 73 million people are over age 70 in America. So the estate tax is of interest.
Yeah, I think if there's 2 things I would say to this. I think if people are relying on the tax code to help get wealth from one generation to the next, they're doing themselves a monumental disservice. It requires proper advice. It requires proper multi-year, if not decade, planning in order to achieve effectively.
Like great investing, it's time, not timing.
It is timing.
One.
There's no doubt about it.
Yep.
The other thing I would say, which
Start
is not
early.
a way of not answering your question, is the fluidity of the tax situation is so dynamic that anybody who sits here and tells you that they know for sure, I guarantee you doesn't know. So let's just talk about timing as a first way of examining this question. New president is going to be sworn in at the end of January. Treasury, obviously, is where a lot of this tax issues will reside, certainly also in the Office of Management in Budget. What can we afford as a government? But staffing those departments isn't as easy as the new president taking the oath of office. So by the time you get the team in place, now it's the summer, okay? If not even a little bit later in terms of a full complement. But let's just say it's the summer. the second piece of this is, what are the administration's priorities? And, President-elect has talked about a lot of different things, as he's prone to, but where are we really going to focus our legislative ambitions? And if it's in extending his tax policy, which, as you say, are coming to sunset in the provision, the timeline really looks like the fourth quarter of 2025 for a bill. If he emphasizes something else,
it'll probably be a December surprise.
It'll be a December surprise. But if he emphasizes something else, Deb, right, and it gets pushed, now it could be even 2026, and that causes a problem because you've got
some consternation.
Some consternation as you go through it. So that's going to have market
definitely.
implications and other things. So we'll be watching taxes very, very closely, as I know you will, and it invites it invites a little 5-minute update on some of these conversations we've had, as we go along the way, because I think it's going to be very dynamic.
Yes.
And it's not the fun part, right? Last year, everyone was focused on the yin versus the yang and who's going to win and who's not going to win. And then you found out who won, and mercifully it was, let's just call it, clean. We didn't have any sort of the intendant issues we knew on Wednesday morning. And then it became about who's going to take some of these other important jobs. Well, legislation's all in the details.
Looks like we're going to have a peaceful transfer of power.
We hope. Yeah, I think we will. And
so
just as an American, that's a good thing. But now when you get into legislating, that's a whole different animal. And people have to remember that regardless of what one side or the other says about mandates or not, in Congress, it's a really tight situation. There's only
There'll
a couple
be a
of seats.
lot of horse trade, a whole lot
There's
of
going to be a lot of
horse
horse
trading
trading.
going on.
Yeah,
right?
And a lot of horse trading going on. And ultimately, I think that makes for a better bill because it becomes more of a compromise, but it takes longer.
Yep. When you've grown in your career, you've had leadership positions, if you think about the best piece of advice that you might have gotten, or the worst, for that matter.
Yeah.
What comes to mind?
People offer advice all the time.
Unsolicited.
Unsolicited, constantly. Got some this morning on my ride over here. Suffice it to say, a lot of it, doesn't pan out, but it does create, I think, a really good template to be in a position to offer advice. And so the only thing I always say goes back to something we talked about earlier, which is sort of along the curiosity line, is that you should try to find interest in what other people are interested in. You know what I mean?
That's very valuable.
I may not love everything that you're sort of really keen on, but if I can find a couple sort of salient points and you and I can have a conversation as we are today about things that may be of interest to you, it really just fosters a better human connection. I have young sons, as you know, and teenagers as well,
All
which
three.
is great. And I was a teenage boy once, so I kind of get the joke.
Right.
But I didn't have the social media. I didn't have the phone when I was a teenager. So getting them to recognize that their brothers have things that are interesting about them, their mother has things that are interesting about her, their friends have things that are interesting about them that aren't always the most important thing to tennis playing teenage boys. It fosters more personal connection, and I think we've lost a little bit of that along the way. So
and anytime we can find common ground,
we're better.
It's a basis.
Absolutely.
For great relationships.
Yeah, and then if you have the right temperament, you might actually find interested in it yourself.
Exactly.
Yeah.
That is great. I really appreciate that, and it's been wonderful speaking with you today and listening. Nick, thank you for being gracious with your time and all that great intellectual curiosity.
No, you're very nice to have me, Deb. I appreciate you.
Thanks.
Thank you.